We think silver is likely to see, $200, and it might even see it within the next handful of months. So maybe you get to February or so, you're going to be focused on trying to define any midpoint stumble. It will be a fake out. What we're arguing is you should do it on a logarithmic scale. For 50 years, you double the range on the log scale, which is like a tenfold range, $4 to 50. You're talking $500. Gold and silver miners, like let's say GDX or XAU, and divide it into the S&P 500 and plot the same chart going back a dozen years. Lo and behold, it broke out also in November. Which place should I be, the U.S. stock market or gold and silver miners? It's when a market discovers, oops, I made a mistake. I shouldn't have been here that long. Silver is now, by our metrics, the spread chart versus gold, especially saying, okay, I'm out of here. We're facing a fiat money crisis.
When we see an economic downturn or a stock market crash, since silver does have an industrial component, silver can get hit hard. Your take on that?
Couple months ago, we adjusted I knew we'd get the 60s. I thought we'd get the 60, 70 by the end of the year, but ultimately it is not a target. I think we've begun a phase in silver that we've explained to our subscribers over the last handful of months is likely to be a jolting one that takes silver to what we call a new reality. Meaning not just doubling the price, but, more likely quadrupling or more the price very quickly, meaning within 2 quarters, thereabouts. The signal that generated that was not the fact that the net trend of silver and gold is positive. They've been positive for a couple of years. They zigzag, but, it's been net trend positive. So it's not that issue. It's the issue of the relative performance relative to, one, the stock market, meaning a breakout that is clear, technically speaking, in which the performance of gold, for example, versus the S&P is no longer a duel, which for the last 10 to 11 years, if you looked at a spread chart of gold divided into the price of the S&P, you'd see this basing pattern with ups and downs within it, which case gold outperformed for a year or two and then pulled back some, and so basically sideways, where it was basing relative to its performance to S&P.
The real shift here isn't silver hitting a number. It's silver breaking its long-standing relationship with equities. For over a decade, gold versus the S&P traded sideways, signaling indecision between real assets and financial assets. As Michael Oliver has repeatedly pointed out, true secular moves begin when relative performance breaks, not when price trends exist. Gold and silver being up for years didn't matter, leadership rotation did. When metals outperform stocks, it signals capital fleeing growth narratives toward monetary protection. For investors, this isn't a trade, it's a regime change that quietly alters portfolio risk assumptions. Next, Michael Oliver talks about the breakout signal that spreads beyond metals themselves.
It broke out of that pattern in November. And now it's 1 month later and we've gained hundreds of dollars and the spread has continued to explode. But also when we analyze gold miners, gold and silver miners, like let's say GDX or XAU, and divide it into the S&P 500 and plot the same chart going back a dozen years, lo and behold, it broke out also in November, meaning which place should I be, the U.S. stock market or gold and silver miners? Well, it said gold and silver miners. Well, they've roared since November. They've been roaring before that, but this thing said something just began. This is a big metric. I mean, you don't build a base that's 11 years wide, clearly defined with multiple highs that hit the same sort of level, and you can draw a line, anybody could, and you break through that. That's a breakout. It's fresh. And silver did the same. But the other thing that we thought was more important for silver is that it broke out versus gold. Meaning that if you want to allocate assets to monetary metals, fine, that's what these charts tell you to do. But within that complex, you want to preference silver. It's likely to lead.
Wall Street rarely talks about relative charts because they expose capital rotation before headlines do. An 11-year base breaking simultaneously in bullion and miners versus the S&P is statistically rare. It signals institutional reallocation, not retail speculation. Historically, miners leading the market has coincided with liquidity stress elsewhere, including 2000 and 2007. The key detail analysts gloss over is silver outperforming gold, which suggests leverage inside the metals complex itself. This isn't a safety trade, it's a momentum transfer. Investors ignoring relative leadership often enter late after the easy gains are gone. Next, Michael Oliver explains why silver may outrun expectations entirely.
Silver's also broken out of its what we call the idiot range, which it's been in for 50 years. $50 for $4, $50 back down, 50 years in a range, an old normality. We showed in reports a couple months ago a similar situation in copper and lead that had prevailed back in the 70s through 2005 to 2007. It's like multiple decades of range-bound action by both those base metals. And in 2005, copper broke out of that range, and in 2 quarters, it quadrupled in price. And then lived in a new reality subsequently. Now it's breaking out again to another reality. Lead did the same thing. In other words, when it finally decided in 2007, on its own merits, to break out of a multi-decade old reality, it quadrupled in a matter of a couple quarters. What's going on here? Well, it's when a market discovers, oops, I made a mistake. I shouldn't have been here that long. Boom. Markets make mistakes. They're not rational all the time. And anyway, silver is now, by our metrics, the spread chart versus gold, especially saying, okay, I'm out of here.
Long-term ranges are not stability. They're suppressed price discovery. Copper's 2005 breakout delivered a 300% plus move in under 6 months, driven by years of mispricing colliding with demand reality. Silver's 50-year range is even more extreme, which increases the probability of violent repricing. Markets don't gradually correct decades of distortion. They gap. As history shows, once a metal escapes a generational range, old valuation anchors become irrelevant. For investors, the risk isn't volatility. It's underexposure to assets repricing faster than portfolios can adjust. In the next segment, Michael Oliver explains why price targets may be misleadingly conservative.
We think silver is highly likely to go, I think personally, my own positions, which I expose in the report at the end in a disclaimer, is likely to see, $200, and it might even see it within the next handful of months. In other words, within a couple quarters of that breakout. So put your seatbelt on and don't expect normality.
They don't expect normality. A lot of people have been expecting normality, but that's not what we've seen over the last few months, and it sounds like you're looking for this to continue here. One of the things that's also caught my eye over the last week or two is just platinum exploding as well. We've seen, a 30% increase in about a week or so. Your take on that?
Well, we examine platinum, palladium, and all the other components of the Bloomberg Commodity Index monthly, technically examine them. And platinum, I know a lot of people like to link it to gold. But unfortunately, or fortunately, whatever, the reality is that if you go back decades and decades and look at platinum and look at gold, they do not correlate well.
Price targets like $200 sound extreme only because investors anchor to past regimes. In prior metal repricings, such as silver in 1980 or copper in 2006, speed, not magnitude, shocked markets. A 30% weekly move in platinum confirms broad commodity momentum, not isolated speculation. As Bloomberg Commodity Index data shows, synchronized breakouts often precede inflationary recognition, not follow it. The mistake is assuming metals move independently. Liquidity conditions move them together. For portfolios, this challenges traditional diversification assumptions built for calmer cycles. Up next, Michael Oliver turns to why volatility won't mean failure in this phase.
There have been times when they do. But there's also been times when the Bloomberg Commodity Index correlates to gold. So, you can't say corn is like gold, okay? You get the point. So platinum broke out by our metrics a handful of months ago. and has since roared. But it did it pretty much in sync with the Bloomberg Commodity Index and, let's say, the action of copper, for example. So we think quietly it is a precious metal. It is not a monetary metal. And that it's not just a subtle difference that's important, I think, because ultimately what we're facing here for gold and silver, that's something the analysts just don't seem to get their head around, is that we're facing a fiat money crisis. And we've had like 100 years of that unbacked stuff, and it's finally reaching a crisis point because the focal point now is the U.S. government and Japanese and UK and et cetera, debt markets, their debt.
Platinum's surge looks impressive, but the reason behind it matters far more than the price move itself. As Bloomberg Commodity Index data shows, platinum's breakout is tracking industrial metals like copper, not monetary hedges like gold. That distinction matters because only monetary metals respond directly to currency credibility crises. Analysts often lump all metals together, masking this structural divide. With US debt now above $34 trillion and Japan's debt to GDP still near 260%, liquidity stress explains commodity momentum, but only gold and silver price the failure of fiat itself. Next, Michael Oliver explains why this debt problem is nearing a tipping point.
And when you reach that crisis, you've reached the big one. And that's when the issue of fiat currencies comes into question. And already there are movements we know around the world, here, there, in this country, that country, to move more toward a gold-backed situation. And this coming crisis, which, again, I don't see analysts talking about, is going to hit. And when it hits, then suddenly they'll say, gee, that's the reason, huh? Oh, now I understand. Anyway, that's where I think we are, and I think 2026 is going to expose almost all of it.
And there have been people calling for pullbacks here and there. We saw a little bit of a pullback in silver when it hit 54 and then it went to 45. But even, buying at that top at 54 sounds now pretty great, pretty low price for silver. So your take on, I guess, moving forward here, do you anticipate pullbacks along the way, or do you see it pretty much just, as you mentioned, silver moving into a new reality quite swiftly?
Well, if you go back and examine the two acceleration phases of silver that occurred within the old reality.
Most analysts model markets as if currency credibility is permanent. History says otherwise. Since 1971, fiat systems have relied on confidence, not backing, and that confidence is now cracking under sovereign debt pressure. Central banks added over 1,000 tons of gold in 2023 alone, signaling quiet preparation, not panic. Pullbacks like silver's dip from 54 to 45 look dramatic only inside an old regime framework. When price resets to a new monetary context, former tops become accumulation zones. Investors waiting for perfect entries often miss structural repricing cycles entirely. Next, Michael Oliver talks how the historical playbook for silver acceleration comes into focus.
That would have been 1979 to 80, when after years of advancing already at that point, silver exploded. It like quadrupled in a matter of 5 months it was. Went from like $12 to 50, okay? And then in 2010 and 11, again, after years of advance, so it wasn't like some new game, silver doubled in a half in about 7 months. Boom, okay? But in the middle of both those moves, if you micro-analyze them, which we've done, there was, in fact, a midpoint, what you might call stumble, or a midpoint pause, or a midpoint correction. It really didn't amount to much other than, for a moment in time, making people feel like, oh my gosh, that's the top. But that was only like 3 months into what we define as the couple quarter move. And so sure enough, after that little jig-jag was over, about in the middle of that clock, they exploded again, even more so than what they'd done in the first half of that clock. So the question now is, let's say we got a signal in the close of November. So let's say this is month 1, 2, 3.
Silver's most violent gains have never been smooth. They've been emotionally disruptive. In both 1980 and 2011, Mid-move pullbacks shook out late entrants before price doubled again. These pauses weren't trend failures, they were positioning resets. Historical volatility data shows silver routinely experiences 20-30% corrections inside bull accelerations. Investors who mistake noise for reversal often exit right before momentum compounds. Understanding this pattern isn't about predicting timing. It's about maintaining conviction through discomfort. Next, Michael Oliver explains why the midpoint matters more than the peak.
So maybe you get to February or so. At that point, we're going to be focused at MSA on trying to define any midpoint stumble. It will be a fake out, but we still know that there's a lot of, including myself, a lot of investors who are positioned in call options and therefore are sensitive to such fluctuations. So it would be an important thing to avoid if you can, but you don't, as an investor, want to get out of silver at that point. In fact, you don't want to get out of silver, period, even after the 6-month move, because there's a new reality about the dawn. And while price will have made much of its move, the interesting point, though, will be, let's assume the 6-month clock is about right, give or take a month, okay? And again, this happened to copper, it happened to lead, it happened to silver twice in the past 50 years. Where are you going to be at the midpoint of that move? Could be very interesting. Are you going to be 80, 95, let's say $95 to $100? And I picked that because that's a stupid level. Why is that stupid? Because if you take the arithmetic range of the past 50 years and you simply add it to itself,
options positioning quietly amplifies volatility more than fundamentals ever will. CFTC data shows leveraged exposure tends to peak early in accelerations, increasing the odds of sharp but temporary shakeouts. The mistake investors make is treating midpoint prices as final valuations. As Michael Oliver emphasizes, arithmetic targets ignore exponential market behavior after regime shifts. When silver exits a 50-year range, linear thinking fails. Selling during a midpoint stumble often locks in opportunity costs rather than reducing risk. Next, Michael Oliver challenges why traditional price targets may be dangerously misleading.
the target would be roughly somewhere close to 100, $50 range added. So it's sort of an idiot technical analysis. What we're arguing is you should do it on a logarithmic scale. And if you take that range that was like $4 to 50 for 50 years and you double it, you double the range on the log scale, which is like a tenfold range, $4 to 50. You're talking $500. Don't chuckle. The interesting thing, well, where will we be, let's say, about 3 months into this move? Will we be under 100 or will we be well over 100? And then we get a jiggle. Because that sort of sets your dynamics. You think, well, if we got this far in the first 3, good grief, where are we going to be in the next 3? Maybe 200's too low. So we're not certain on where that peak might be in 6 months or so. Although I would argue at least 200. But a lot's going to be told in the next couple months. Where do we go, let's say, within 3 months of that signal?
The real tension here isn't the $500 number. It's how fast silver could invalidate traditional price models. What he's calling out is a flaw in linear thinking. Most analysts anchor to nominal highs instead of logarithmic ranges that capture regime shifts. Silver spent roughly 5 decades oscillating between about $4 and $50. And doubling that range on a log scale implies exponential, not incremental outcomes. Something technicians like Michael Oliver have repeatedly warned about in momentum breakouts. If silver is already pressing triple digits within 3 months, it suggests acceleration, not exhaustion. That matters because parabolic moves compress time and eliminate comfortable pullbacks investors wait for. What Michael Oliver hints at next reframes whether $200 is conservative, not aggressive.
Now, a lot of people note that when we see an economic downturn or a stock market crash, since silver does have an industrial component, silver can get hit hard. Your take on that? Do you anticipate a downturn in the stock market? And a lot of people are considering that metals might sell off, especially silver, it having an industrial component here.
No, that correlation, by the way, is a coin toss. We've studied it, put out reports at length going back to the 50 years or so, examining the movements of gold, the miners, etc., during stock market downturns. And the response by gold, the gold miners, silver, it's a little bit different each time.
The assumption that silver must fall during downturns sounds logical, but history refuses to cooperate. What Michael Oliver is pushing back on is the lazy narrative that industrial exposure equals automatic downside, ignoring decades of mixed evidence. Studies going back roughly 50 years show metals often decouple from equities during stress, depending on liquidity conditions and policy responses, not GDP headlines. Analysts routinely cite industrial demand risk without accounting for monetary demand that surges when confidence breaks. For investors, that distinction matters. Silver isn't just a cyclical metal, it's a conditional hedge. Treating it like copper can misprice both risk and opportunity. Next, Michael Oliver explains when correlations break and when they suddenly snap.
But not always do they respond to sharp stock market downturns. And plus, I say sharp because the stock market could go down and it won't affect silver and gold at all. I mean, you look at 2007, let's take as an example. It peaked in October 2007. Dropped November, December, January, February, March. 6 more months passed while the stock market was declining, not collapsing, declining hard though. And gold was continuing up, and miners were continuing up during that same 6-month period. It was only when you got to September, October of 2008, a full year after the bull market peak in stocks, way off the price high, that finally gold and the miners and silver have a very sharp drop that seemed to be correlated to the S&P, although they certainly weren't correlated in that first year of the bear market of stocks. So it's an iffy correlation.
The media loves neat correlations, and markets rarely deliver them on schedule. This 2007-2008 example exposes how misleading risk-off narratives can be when stripped of timing. Stocks peaked in October 2007, yet gold and miners continued rising for nearly a year, contradicting the idea of instant contagion. The real collapse only came during the forced liquidation phase in late 2008, when everything was sold to raise cash, not because fundamentals suddenly changed. That nuance is often buried in headlines. For investors, it means drawdowns don't define metals, liquidity events do.